Hello, 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 and welcome to everybody who is here with me. Just checking in and letting everybody know this is the session where we're going to go through these. I told you I'm going to try and be a bit more aggressive with some of these. Um, just trying to get this loose. It's Friday. It's like ties don't want to be on Fridays. It's against the code or something. So let's see how many people are going to be here with us as we go through today's financial data. I know it's Friday and it's first pay Friday, so people can't wait to get their swerve on. Um, but yeah, I'm just here to give you a little bit of data so you know where your money is and what's happening. Okay, let's see who's here. Give me a name and give me where you're joining me from today if you're here with me. Just taking a look. Okay, so we're going to get this started in about just 4 or so minutes. Just a brief on what is happening in the wonderful world of your money. Um, so, as I said, give me a shout out. Where are you joining me from? What's your name? Okay. All right, Casella, thank you for joining us from Waterfalls. Let's see who's here with us as we are picking up everyone here. Okay. All right, we've got a few people in. Chilu from Kidsway, thank you for joining us. Okay. Everybody else who's here, please. This is your chance to understand. And if you have questions about trade and inflation, please stock them up. I don't mind answering them just for this period. Yes, you have a moment with macroeconomists to ask a few questions. Don't be shy. It's time to know what you need to know. Okay. Don't be afraid to. And I have got a little report that I did earlier today on Money FM. So I'd share it again, just so that we could clear up some of the information that's got to do with inflation. I know that there's been a lot of conversations today, lots of them, regarding where we are on the inflation train, especially to do with grain. I think that's been the biggest conversation point, especially to do with grain inflation. That's been a huge one for people. So, yes, as I said, please feel free to ask the questions you need to ask so that we can answer what you need answered. Okay, right. And we are 3 minutes in and we're going to get started. We are 3 minutes in, and like I said, whoever's with me, please give me a shout. Where you joining me from, and what's your name? If you're joining me from, you want to get to know here what is happening with inflation, what is happening with trade, because remember one major thing when you are making investment decisions. Remember, I'm trying to get your portfolios right. Some of you just did your bond auction. Some of you are looking what stocks to buy. Everything. Remember that when we're doing all of this, we are working according to the Dalio matrix, which simply looks at the growth of inflation and the growth of assets. So, just as something that we can revise here for everyone to remember is that there are only two economic conditions ultimately that affect assets and that affect the performance of assets. There are only two economic conditions that affect the performance of assets, and that is economic growth. Thank you very much. Sonka from Chinsoka Musona for joining us from the UK. We're international. Check the statistics. So there are only two economic conditions that affect which assets perform best. That is growth and inflation. Everything else is news. The point is, how does it affect growth and inflation? And think about growth and inflation like the two main things that affect what kind of clothes you wear. Precipitation precipitation, in other words, how much it rains. Sorry about that. Precipitation, which is how wet is it outside, how dry or wet is it outside. That's a very important thing. And also, how hot is it? These are your two climate conditions that affect the kind of clothing you wear. So just remember, when you're looking at what economic conditions affect what assets will perform well or perform best, it's growth and inflation. So I want you to think about growth like precipitation, because if it's hot and it's raining, then there's specific clothing you'd wear. If it's cold and raining, there's specific clothing you'd wear. If it's hot and dry, there's specific clothing you'd wear. And if it's cold and dry, there's specific clothing that you'd wear. So I just want you to pay attention to those important factors when we're looking at how this affects. So remember, trade will affect growth and industrial demand, while inflation will be affected. Inflation will have a strong impact on the cost of things. So yes, thank you to everyone for joining me. Let's get started. So getting started today, one of the first things that we're going to talk about is the inflation read from yesterday. And I think a lot of you saw this big print that came out yesterday that inflation was 9.4%. I think you all paid attention to that. Inflation came down and everyone was wondering, because we're all seeing the cost of things going up, whether it's fuel, whether it's transport, whatever it is, you're seeing the cost of things going up, and it's confusing that you saw inflation going down, and it doesn't make sense to a lot of you. So let's try and consider what is it that could be causing parts of this. I'm just going to really work this out. And this is brought to you by my firm, Zatu Financial Consultants. Tomorrow begins today. And remember that we do this in line with everybody who has done bond education and learned how to invest and gotten ahead of it. So let's start talking about this. So the first thing that you'll notice here is that inflation yesterday, as I said, went from 9.9% to 9.4%. Now that is something called base effects. Now I just want to come out of this and have a conversation quickly about base effects so that you understand what that actually means. Now, base effects means that the inflation, and I want everyone to get this very carefully. If you see a police officer standing by the side of the road with a speed gun trying to pull over people, he's not pulling people over for the distance that they move. He's pulling people over for the speed that they move within a certain distance. Okay, I want you to understand that. What speed, what kilometers per hour was a person moving? So when the Zambia Statistics Authority or the Zambia Statistics Agency comes out and they give you data on inflation, they are not giving you the levels of prices. They are giving you the inflation rate. So I want you to think about this. A police officer stands by the side of the road, not assessing how far you moved, but assessing how fast you moved in a given distance. And that's what that speedometer does, that speed gun. It assesses how fast you are moving in a certain distance. So what inflation is how fast are prices rising, okay, in a month. Okay, and what they're looking at is two types of inflation. There's two inflation reads you get. You get what's called the month-on-month inflation, which means what was the percentage change of the prices of things from last month. That is called month-on-month inflation. Now, sometimes that's not a good read because some things are seasonal. For example, airline tickets are seasonal. Some months, airline tickets are more expensive than other months because of demand. Sometimes tomatoes are cheaper than other months because there's excess. They're in season. So when certain things are in season, in other words, there's a lot of them available or there's excess amounts available, you find the prices are cheap. And when they're out of season, when they're difficult to find, you find they're expensive. So, I mean, you find when they're out of season, so when they're in season, which means there's abundance of them, you find they're cheap. When they're out of season, when they're hard to find, you find they're expensive. Maize, when it's in season, is cheap, and therefore milli meal becomes cheap. That's why in the what I call the inflation valley, if you look at the months of the year, from about April going all the way to November, Okay, from about March, going all the way to November. That's what I call the inflation valley, where the prices start to cool off and then start to pick back up. That period is why we call it the inflation valley, is because there's maize that is on the market, and therefore the price of mealie meal starts to come down. So therefore the cost comes down because it's in abundance. So one of the reasons why we don't always rely on measuring month-to-month inflation all the time is because it represents it may not represent the seasonality of things. So the best way to measure inflation is to say January this year versus January last year, what was the difference in prices? But sometimes when the price rise was too high in January, okay, last year, then you have something called the base effect. The base effect simply means there was such a high escalation or such a movement that affects today's price. So today's inflation read was affected by that. This one that we got was affected by the rapid price hike last time. So that's why it looks like it's only 9.4%. And how do I know this? I'm going to explain it using a tool that we use at our firm for measuring month-on-month inflation to see, is this month excessively inflationary? Is it not excessively inflationary? Now, we use the monthly inflation reads to assess, was this month highly inflationary? And we have developed a metric that we're able to do. So come into my session with me. Now I can finally show you this. Okay, so if you take a look, there are 3 lines here that we have put on this chart here. The first line is this black one with the gray dots. This main one with the numbers on it. That is the month-on-month inflation numbers for each of these corresponding months. I think you can see the months that we have down here. Then the red line here, this faint red line with red dots on it, is what we call the monthly benchmark, or what we call the expectations curve. Now, let me explain where we got this from. The expectations curve is the average inflation, month-on-month inflation of that month over the past 10 years. So if we take February here, okay, at the beginning of this curve, we took the 10 years preceding this February, found out what the average month-on-month inflation was, and that's what we expect, because we use averages for expectations. And we did the same for March, we did the same for April. So this is the expectations of what is month-on-month inflation. So now we can see, is the inflation that came in this month above average? Now, this gray curve is also looking at the previous year. What was the previous year like? So now let's go to the end here where we have this month's inflation, January 2022. And please feel free to ask questions about this. Now, you'll see that the month-on-month inflation for January 2023, I'm going to say it again, January 2023. This month's January 2023 was 2.07%. So in other words, prices on average of the basket of goods that we measure rose 2.07% from last month, December 2022. Okay? Now, what is the average of January 2023? When you go back, January 2022, 2021, all these averages, what's the average been? 1.05%. So we can state, okay, using this expectations curve, that January's inflation was actually higher than expected. The price movements in January came in higher than expected, okay, because it's only expected that we get 1.05% inflation movement. This is the data that we collect every single month. So whenever we get it, this is our own one that we created to make sure that we could measure and remove base effects. So this is how we've removed base effects to see whether inflation is above average or below average. And what we're currently getting is way above average, actually almost double the average inflation. So this was actually a very inflationary month. Okay, that's what the data is showing us. Not my feelings, not what's in my heart, or what I want to say. It's what the data is showing us, that we actually had a highly inflationary month. But when you measure it against last year, where the inflation was 2.5%, it's still a bit lower than last year. So last year was highly inflationary for the first month of the year. So in January, we expect inflation to be 1.05% because that's been the average over the last 10 years. And now we got almost double that, meaning it was highly inflationary. Okay, that's what this tool of the expectations curves allow us to do. It rids us of base effects, and then we can look at what is actually transpiring with inflation. This month was highly inflationary. But what is happening? So let's take a look at what actually caused this. I'm going to have to move the logo for a little bit just to make sure that we get this correct. And yes, thank you, Chufi. Said I really I like the speed gun example. It makes it really easy to understand. Exactly. The point is I would like this to be as easy to understand as possible. So now let's take a look at food inflation. So there are two types of inflation that we measure. We measure food inflation and non-food inflation. So I just want to get that out the way so that we can make this easy. Okay, so with food inflation, what did we get? The percentage change in food inflation was up 2.76%. But if you look at the same red expectations curve, we've been measuring food inflation, and we found that 1.16% is the average inflation. So I think when you look at what I call the inflation hill and valley, you can see that from February here, the inflation's coming down. It gets to about this middle of the year part, and it starts to pick up again. This is monthly inflation. So it shows you that inflationary pressure builds up, and it's very simple. In Zambia, it's actually a very simple way to think. The hotter it is, the higher inflation is, the colder it is, the lower inflation is, simply because of rain and because of abundance of food. Okay, so what we find is there isn't as much of an abundance of food in the hot season because everyone's planting. So as you can see, food prices were up 1.6%. Was supposed to be up 1.16%, but we're up over 2 times that, almost 2.5 times that. Okay, 2.5 times that is what. Almost 2.5 times, not 2.5, but almost 2.5 times that. But this is what we're looking at: 2.76%. Now, if you look at the gray curve, you see that above that there was higher inflation last year, but only slightly. So this was a very inflationary food year. Food prices came in really, really hot. So we had a problem with food prices. And I think we've seen in today's news that there was issues about the abundance of maize, and therefore the FRA had to actually offload maize. And as a result, you started to see prices coming down. Because if you look at the milling companies, 80% of maize, of your milli meal price, actually comes from the maize price. For the life of me, I don't know why we stick politicians on TV to ask them about maize prices when you just go and have to ask the milling companies and the commodity traders. Those are the people who understand. Sit down with the commodity traders, sit down with the milling companies, and you'll get to know exactly what's happening in the dynamics of an industry. Okay, we need to stop asking politicians economic questions and business questions because we're confusing society with that. Politicians can stick to policy issues, but let's focus on what's actually happening in the economy and get it from the people who are actually managing these. So inflation, as you noticed, only came up about 1.1, was supposed to come up 1.16%, but was 2.76. So amongst the food basket, here's a new thing that we've come up with called the kitchen table inflation index. This helps you. So what we call monthly kitchen table inflation. We have taken the prices that we get from the report and we started to look at what were the month-on-month movements in prices amongst products that caused this huge spike of 2.76% of inflation. And let's take a look at it. Grain products, on average, moved up by 4.4%. So you can see the red bar is January. The slightly light red bar is December. So we can see that across all food aspects, we saw higher inflation. All food, okay, all food groups. So we call it the kitchen table inflation simply because it represents the things that would be on your kitchen table. Okay, these are the things you prep food. So this is your food and your food items, your basic food items. So grain prices in general were up 4.4%. Okay, in this month. So you can see that that's highly inflationary. 4.4% movement in a month on grain prices when salaries only move up 6% is really high. In a year, by the way, salaries move up like 6 to 8% in a year, and you're seeing grain prices moving up 4% in a month. That when you annualize a 4% movement in a month, you get numbers very, very high. So you're trying to avoid this situation. But obviously, when it's off season, that's when you'll see that it gets more normal. Now, when you look at meat prices, now this is versus a backdrop of December where we saw 0.4%. You're also looking at 2.6% in meat prices versus 0.6% in the previous month. Chicken and eggs, it was mainly chicken. Live chickens were up almost 20% just in the month, but eggs barely moved, so it averaged out at about 10%. Fish was up. Fish and fish-related products, being your Capenta, those kind of things, Bream, Capenta, various things, up 4.8%. We saw zero movements in things like sugar, salt, cocoa. These are condiments. They only moved up by 0%, or very low, versus dropping by 3.5%. So you can see there was still inflation in them. And vegetables were up 4.3%. So in order, what we actually found was that grain, it was a situation of chicken, fish, grain, then vegetables, and finally meat and condiments. So the kitchen table across the whole spectrum, we saw very high levels of inflation in the kitchen table. And this is where some of the problems probably came from this month, and why you're experiencing quite hurtful inflation during this. So this was your food prices. So now, if you're looking at monthly inflation, now let's just go back to some of these food prices where the problems also come in January, especially in grain farming. What you often find, especially maize, soya, these things, is that because they're off season, this is when people start to hike their prices. Some of you get opportunistic traders who move these things also into dollars because they want to export. So whenever you see the kwacha getting weak and there's off season food, what starts to happen is food becomes expensive, because if I've got maize and somebody in DRC wants to buy it versus somebody here in Zambia, and somebody in DRC is offering me dollars and the kwacha is getting weaker, that price in DRC is getting better and better and more profitable for the exact same maize I've grown, to a Zambian who's offering me a low price. So what happens is that people start to go for export markets, and they start to determine that, and the export market starts to control the domestic price. Okay, that's where the problem comes. When the kwacha is getting weak, the export market starts to control the domestic price. We've seen this in cement. We've seen this in maize multiple times. We've seen this in all kinds of products that can be exported. So even electricity, by the way, what usually drives the electricity rate up is that ZESCO makes more money exporting electricity than selling it to the people here. I mean, I gave people the curve before, where you find that the average household is paying 56 in for electricity on average. Okay, when you now start looking at what the average consumption is, or you take the total amount of electricity earnings by ZESCO divided by the total amount of electricity sold to households, you find that 56 in is what people are actually paying per unit, while mines are paying about a kwacha 86, and export markets are paying higher. So already you can start to see that your load shedding and your desire for ZESCO to try and export electricity comes from the fact that they are making more money sending the electricity out than selling it to you. And so the pressure is on ZESCO to raise the prices up. And so the export market, whenever you start to see anything that's exportable, the export market will start to dictate the domestic price, or pull the domestic price upwards, when the kwacha is getting weaker and the dollar is getting stronger. Okay, so this buying cycle has really messed us up, because it's created a very weak currency that has made it more profitable for people to hold their main stock off the domestic market and push it out onto the international market. Now, the Bank of Zambia actually did talk about this in their last MPR meeting, where they said one of the inflation risks that we face in Zambia is regional demand for food. The governor actually said this. And he said that when these people don't have enough food, they come swarming into our country trying to get anything that we're growing. And as a result, it will drive prices up. So I'm going to read you some data on export data on food. We're actually exporting record levels of agricultural produce. But what that's also doing is it's putting pressure on the domestic market. Now, you can't get rid of export because that's jobs tied to it, and income and capabilities. But at the same time, it's causing inflation. So we have to ramp up production as a country and make sure our supply levels are really high, so that we can serve both the external market and both the domestic market without harming either one of them. So these are just some things that you're often seeing. So domestic demand for our products often creates export-induced inflation. Okay, I want to repeat this. Export-induced inflation. I want you to think about this very carefully. If a Zambian is buying milli meal for a bag of milli meal at a price of, let's say, at a price of 160 kwacha, 180 kwacha, but someone in the DRC wants to buy a bag of milli meal for $100, not kwacha, dollars, Nobody's going to sell to the people here. Okay, it is of no profit to sell to the people here. It's maximum profit to get that stuff across the border. This is why we used to have smuggling problems the moment we started to do export bans in Zambia. You just see people along the border moving bags of mini meal because it is worth a lot in these other countries. Okay, so that's something I just want you to all kind of grasp in your mind so that we can understand it very well. So I hope if there are any questions there, please feel free. Now let's get into the non-food inflation. As we've seen that non-food inflation was more inflationary, obviously due to a weaker currency because a lot of these things are imported, but it wasn't as high. So you could see that the difference between the expectations curve of 0.98% of monthly inflation in January for non-food inflation was not far from the 1.14%. So non-food inflation was not the key driver of inflation. So therefore you could see that non-food inflation, yes, being strong, but it was not the key driver. So it wasn't as hard as food inflation, which was almost over double the amounts. Okay. Now let's take a look at the different categories so that we can even see amongst non-food inflation what was pulling inflation up. So let's take this is what we call monthly inflation reads for food and non-food. The first column is for food inflation. You can see that it's 2.8% or 2.78%, like we were talking about earlier, versus 0.5% in the previous month. So that's a huge spike, a huge spike. Okay, if you go back, that's a huge spike in food inflation. Look at it where it went from. It went from 5.2% in 0.52% in December to 2.76%. That's a mega spike in food inflation. And what we're seeing now, also now, if you look at alcoholic beverages and tobacco, they only moved up by 0.5%, not much. Clothing and footwear up 0.7%. Housing and utilities up 1.1%. There's one of the pulling factors right there. Housing and utilities. There was a problem there. 0.6% of furniture and equipment. Health up 0.6%. The other one is transportation. Transportation costs, which were waiting and lagging, and have become very inflationary over the past few months. Now, it is down from where it was in the last month, 5.2%, now down to 2%. But that's still really high, by the way. 2% of monthly inflation on transportation costs mainly means that we're starting to get to that point where these oil price movements have really started affecting the market, and then probably some historic ones. And right now, we're probably on the cusp of another oil price movement upwards. I'm expecting about 2.6 to 3% of an oil price movement, moving it back up into 25 sometime this month. Now, let's take a look at also even things like recreation. It's only up 0.4% in January. Obviously, the end of the holiday season pulls down the price of recreation, but even though it was negative in the previous month. Education is another one which also pulled up prices up 4%. It was the highest and most inflationary thing this year. Obviously, it being the new year, a lot of schools probably ramped up a lot of their costs. And we've been seeing this, by the way, in the education sector. As it's been economically recovering, the demand for education has also pushed up the cost of education because we have limited private schools, and we're seeing a lot of people pushing themselves there. And especially because crowded schools have now created crowded public schools have created crowded private schools. So a lot of parents are pushing their kids out of public schools into private schools, and a lot of private school owners are actually talking about enrollment crowding, that they're getting huge amounts of applications for enrollment, and that's actually causing quite a bit of a trauma there for them. So now the other thing that we're seeing also is restaurants only up 0.6% and miscellaneous 0.8%. So the key drivers of inflation this month were out of the non-food basket were education, transport, and housing and utilities. But really, it was food inflation that was the main driver. And if you look at it from an annual perspective, food inflation up 11.6% versus 11.9%. So it's really high. And as you can see, things like education were not really that high because it was only that last month where we really saw the push up. And the rest of these things have got some base effects pushing them up. This is annualized. Then finally, one of the main contributors to inflation we saw was 6.6% in terms of food inflation. That was the major contributor as usual. It always is the major contributor. The next major contributor was housing utilities, up 0.8%. Main one that actually pushed inflation this month. This was annual inflation. While we're also looking at clothing, the next highest contributor was clothing and footwear, 0.5% inflation, mainly due to the FX rate. That probably did quite a lot of that damage, and transportation also up 0.5%. So these are the main contributors to inflation. Now, what does this all mean for us? those of us who I'm talking about things like trying to trade our positions. Well, we are seeing early year inflation pressure that is higher than expected. So you've got short-term inflation pressure also driven by the fact that you have an FX rate that's performing negatively against you and shortages of things on the market. And what this often means is you want to continuously pile in. So the short-term inflationary pressure is going to create some back-end inflation as well. So I am suspecting that 2.8% of monthly inflation that we just saw this month is going to build into the end of year inflation picture, and it's probably going to be a little bit tough to see us end the year in 6 to 8% inflation, maintaining single digits. So already these are signs that the early parts of the year. So if we see February and March continuously deliver higher than expected inflation, then we should be worried about this year probably not ending at between the 6 to 8% range. And therefore, I always say to people, pile in now before interest rates start getting pushed down. Remember that in inflation and relatively short growth, your best asset are your inflation-linked bonds. Those are your best assets and your defensive assets. So when you look at government bonds this month, the year to date, in other words, just this month alone, have performed quite strongly, actually. Government bonds have performed relatively strongly to the point where I think they've performed relatively well to the point where they've covered the inflation with a little bit of excess. So we've got about 2.3% performance on government bonds for the secondary traded market, but for the primary traded market, we've got above 2% already. So we've already managed to exceed the 2% when it comes to bond performance now. Now, the thing is, this has already covered your inflation. The stock market is in negative right now, and the best performing asset is actually gold and the dollar. So what we're seeing is that defensive assets are your strength: bonds, gold, dollars. This is where your portfolio is probably going to perform. So if you've had a nicely diversified portfolio, if you look at the performance of your gold, remember how to get access to gold, your stocks and your dollars, your bonds and your dollars, you often find these ones have done pretty well. The stock market has been negative for this month. It has been a higher priced month. It has been, you have seen, electricity problems, so slower growth. And we're also coming off the back end of some bad industrial growth data coming out of Zambia, also with PMI data that was negative. So taking a look at this, higher inflation and possibly compromised growth, and we'll see that in March when we're reading the data for the end of the year, but possibly compromised growth will often show that we didn't do too well. We're not starting out the blocks too strongly as an economy, so therefore you need a defensive parts of your portfolio to be well. So those of you who are all in stocks, you need to kind of widen out a little bit, make sure you've got the defensive part, which is your bonds, your gold and your dollars. That is your defensive part. Now, really, the majority of it can be in your bonds, and your dollars and gold will be able to give you a little bit of cover. Because right now, gold in Kwacha is up over 10%, and dollars are up almost 5%. So you can see that holding dollars has managed to outpace inflation for now, but not forever, just for now. Because if these deals come through where we actually manage to restructure our debt, those dollars are going to become poisoned very quickly. It's going to be difficult to offload them. So don't try and play the game where you pack in so many dollars, but by the time that things turn around, you're going to be in trouble. So hold the dollars as a fringe asset, or what we call wealth protection. Okay, hold your dollars and gold as wealth protection. Main asset to defend in this area is your short-term intermediary bonds. So your 3-year bond is your game player here. 18.6% return on investment. And then that's if you're holding it only for now. And if you're holding some of the old historic stock in your 3-year bond, if you've been trading for 2 to 3 years, you're seeing about a return on investment somewhere in the mid-20s annually. Therefore, you've been able to cover your inflation. And then your bonds and your gold and your dollars have been able to do some outpacing of inflation to help your portfolio. So that's probably where you're sitting. If you have a bit of gold and dollars, you probably helped your portfolio out. So that's why we said about 5 to 15% of your portfolio can be things like gold, crypto, and dollars. That would help. Even the cryptocurrency market has done a bounce back during this time, but that's for different reasons, not for inflation. And gold is doing well because the global economy is getting ready for a recession because they're seeing poor signals of earnings from the US markets. That is giving them recession indicators, plus the inversion of the curve, plus the potential of Tokyo inflation being too high. There are signs that's why you're seeing gold performing well. So this part of your portfolio, you just need inflation protection, and you need downward economic trends protection. So that's where your dollars and gold are going to sit for now. Your stock market is not going to do too well right now. It is a bit sick at the moment, and it's waiting for the economy to get more positive there. So that's some data I wanted you to look at. So now let's take a look at trade. I want to take you through the reads on trade. And to everyone, please, again, you have questions to do with inflation and to do with trade and to do with what portfolio plays to make there, please feel free. That's what these sessions are for. Okay, so let's take a look at trade data. Trade data yesterday, we read it and we found the first negative performance of our trade. In other words, the trade deficit. In other words, we imported more than we exported for the first time in a month, and that was the first time since the pandemic began. The first time, okay, since February 2020 was the first time Zambia has recorded a trade deficit. Okay, and this has been driven by poor copper output. We've had really bad copper output. Maybe these mines are in the middle of trying to do exploration, but right now they are not pumping out output, and it's been pretty weak. Okay, so already we saw that $26 million negative. In other words, we had more imports by $26 million than exports, and we've been constantly doing that. And you see that month on month, that's even 115% downwards. We actually had 76 million previous month. So what were the performance last time? So let's take a look at agricultural out export. It was down 17% from the previous month, but an $83 million, but it's still up 15% from the previous year, December, the previous year. So this is end of year data. What we're seeing is that non-agricultural, non-traditional exports were up 23% from the last year, but down 6.6% from the previous month. So agricultural exports and non-traditional, non-agricultural exports were decent, at least versus last year. Problem comes with copper. As you can see, copper export was $533 million, and that was down 32% from where this was last year and 17% from where it was last month. So weak copper output was the main driver that drove exports to drop by 19% from where they were last year and 14.6% this year. That making sure that unfortunately this $835 million was bad. Now let's take a look at the import side of the equation. We see that on the import side of the equation, raw materials are up 121% from last year. So you can see that we've been importing a lot of raw materials, and that's also because of the cost of raw materials. Intermediary imports were down 9.5%, so from last year, and down 3%. So we can see that's not the main driver. Capital imports were the big thing. 82% up on capital imports, 14% up this month on capital imports, and a little bit of a bump up in consumer imports, $154 million worth of consumer imports, but it's still 17% less than last year and 23.2% less than pre-pandemic levels. So consumers are still consuming locally. So these are good signs for manufacturing, that even under these conditions, consumers are still consuming locally and not consuming internationally. So we're still getting quite a bit of domestic consumption. Even though economic growth bounced back to 5.8%, the consumers are still consuming locally more than they were before. So we're seeing $154 million of consumption. That's actually quite good. Of $104 million only of consumer-based imports. But the main one is capital goods. Now, this also speaks well, by the way, for industrialization, because $448 million of capital goods coming in. Half of the imports of last month were just imported machinery. Half of it was just imported machinery. That's actually good for our country. That means that people are using the currency to import things for productive activity. So that's another good sign for manufacturing. That manufacturing capacity or production capacity of this country seems to be improving, whether it's in the mineral sector or whatever. It seems to me that we're putting a lot of money into manufacturing and productive activity. So even the imports, though we had a deficit, it really was the case of capital. Okay, because when you start to remove it, capital did very well. And I always want to try and remove capital imports and mining. Obviously, if you move capital imports and you remove traditional exports, you'll find that yes, even the negatives that we're seeing are not too bad. So that is the main driver here. So here's the slide that shows here that yes, we've been on a downward trajectory since January 2022 regarding net exports. So we've been on a downward trajectory, and this was just a culmination of it. But we did have some strong trade bounce back. Now, trade drives growth. The reason I'm looking at trade is because it drives economic growth. It's very important to look at trade because of the driver of economic growth. But unfortunately, we're starting to have a slowdown in that because of copper. All of this is driven. And as you can see, somewhere around August, you can see that we almost had an equilibrium point where things were starting to get better, but it looks as though things have been getting worse. And you can see that exports are declining. That green line is your monthly exports versus where they were last year. And you can see that monthly exports are declining while monthly imports are picking up. But the point is that the imports are capital goods. It's not consumption. We're not importing food and basics. We're importing machinery. We're importing things for production. That is very good signs for people. And it means that in the future, we can expect high levels of productive activity going forward. So in the production sector, it does mean that if we do have the demand for it, you might see that it stimulates growth and therefore your stock market start to pick up. But right now, you're not going to see it. But it's an early signal that your stock markets are positioning themselves, especially the industrial parts. Remember that even the Economics Intelligence Unit said industrial growth is going to be stronger in Zambia than general economic growth. So even now, we're seeing this positioning of industrial growth by the imports of capital goods. Now, let's take a look at what's happening in terms of the year to date. So this is the year-end statistics. Now, we had, again, a very strong year, $2.4 billion worth of net export. Mainly because of $11 billion of export. We had $8 billion of copper export, which is 3% lower than the previous year. Okay, it's 3% lower than the previous year. Now, when you take a look at the star performer, in my eyes, the star performer is agriculture. Good one was non-traditional, non-agricultural goods, things like nickel, alternative metals, and manufactured goods. They were good, 24.2% growth from last year and 38% above pre-pandemic levels. But the star performer to me is agriculture. Agriculture has hit a record level of $919 million. That's why I keep saying agricultural export, companies like Zambia for showing a bright future, because this country is actually on a path for $2 billion worth of agricultural export by 2026. It's actually on that trajectory. Now, the other thing that you also start to look at is presidential deals. Now, think about the things he keeps talking about everywhere he goes. He keeps trying to cut export deals for food, whether he goes to Namibia, whether he goes to Angola, whether he goes to Dakar. He's talking about export for food. So he's trying to open up pipelines to get Zambian food out there. Now, it's going to cause domestic inflationary pressure, but it will also unlock job creation for the lower parts of the economy, where those people can actually have more jobs and disposable income to begin with. So it's a bit of a trade-off. There will be a little bit of inflationary growth that might actually pick up here because of the international demand or regional demand for Zambian food. So to offset this, we're either going to have to see that increased capacity finally start to reflect into the machinery. Is it farming equipment coming into this country to help increase the productive capacity of this country so that we can produce more food without having to create more inflation? Because we have more buyers sitting out there who'd like to buy our Zambian food, and therefore we can participate much stronger. So if you can overproduce food, it'll actually be good, because now we're opening up export channels so that overproduced food doesn't have to rot like it used to in this country. So that's one of the things we'll try and work on. So $919 million is showing this. So there are glimpses that the push for capital goods imports might actually be the offset for future export pressure, future export inflation, export-driven inflation pressure that might be coming into the economy. So $919 million of agriculture export is actually a very strong sign for the diversification of export that our country is trying to do. And non-traditional export also doing $2.3 billion is also good. Non-traditional, non-agricultural export doing 2.3, and a $3 billion non-traditional export is always a sign of a strong year. $3 billion of non-traditional exports is always a very good sign for our country. It's always good signals. Whenever we have $3 billion of non-traditional export, that's a very good signal for our economy and for growth opportunities. And if we can maintain that, that's actually quite strong. That's 47% above pre-pandemic levels, and we've had these $3 billion of non-traditional export. We've had it for the last 3 years, so above pre-pandemic levels by 47%. That's actually quite good. Now, if you look at our imports, raw materials imports also above $1.1 billion. That's a big sign negative against us as an economy, but that's also because of the global raw materials prices. That's out of our hands. We're also looking at intermediary goods, which just crossed $2 billion. Those were okay, not too much. You can see it's 23% above last year. You can see that raw materials are up 103% above last year. That's the big inflation push. But you're seeing intermediary goods only up 22%, the demand for them. Capital goods are up 33%. That's why this is very good for the picture. Okay, it's actually quite good for the picture. But we're seeing consumer goods are up 7% from last year. So they're the weakest to grow. I mean, sorry, 2.6% from last year. They're the weakest to grow. So that's why I'm saying the Zambian consumer seems to be getting domesticated. And what we're noticing in Zambia is we're seeing a domestication of supply chains. People seem to be buying more locally. Okay, so the goods and production seem to be happening more in Zambia than it is outside. So therefore, the need to import consumer goods is slowing down. That's why consumer imports are still below 13% before pre-pandemic levels. So the Zambian consumer seems to have transitioned inwards during this time. And I'll tell you why. It's actually quite a simple thing. During the pandemic, supply chains proved to be unreliable. Importing was quite difficult, and consumer goods were now constrained. So people have started looking for domestic versions. People want to produce potato chips domestically. So now we've got this potato chips brands that are coming out. People are trying to produce what they can domestically to avoid having to import. And what happens if the pandemic, if the borders shut again and we can't trade with each other? As a result, we've seen that trade from last year, net trade is down 39%, but still 2,000% higher than pre-pandemic levels. And we're seeing that 1.1% decline from last month because that was the first time we ever saw negative trade. So let's take a look at what are the drivers of this. Obviously, year-on-year inflation. You've seen that while both the speed of imports and exports are both declining in terms of year-to-date figures, what we were seeing that is that the speed of exports were declining faster than the speed of imports. And that's why you're starting to see that trade deficit. So export growth really slowed down drastically over the last 2 years. And we saw it now culminate into the first trade deficit that happened in December, a month where we don't really expect trade deficits. Now, part of the main driver here is copper. As we've said, this is the lowest copper sales. If you look at December 2022, we've seen copper output, export from copper or traditional exports only made $533 million. $533 million is the lowest since August 2020. If I just get my notes out here, but it's the lowest since mid 2020. So that's been the key driver. Yes, I think that's what we got here. The lowest since August 2020. $533 million is the lowest since August 2020, and that is what caused the deficit. And that's the first time, by the way, we've dropped below $600 million of export. So you can see that this was a drastic decline, and it was driven by output. So you can see here also, it was a 33% decline in copper export in terms of the monthly data, the monthly percentage change data. As you can see, before we were having very positive growth, but since August we've been having really bad. There's been declines in copper export on a monthly basis. And as you can see here, it's right here. So this is the little hiccup that's going to happen to stocks like CEC in the short term. Stocks like African Explosive, these slow levels of output coming out are going to have a little bit of a hiccup at the beginning. And we're seeing that copper is taking a little bit of a time to get out the blocks, even though copper price is performing very well right now. So 66,900 is what we saw in terms of the copper metric tons that were pushed out in December. 19% below the last month, 17% below the last year in this month last year, and 8.2% below where we were 2019. So all around an abysmal month for copper output, and it led to a slow month of copper, 0.6% down from where it was year on year. Now, this goal of getting to 2 million tons by 2026 seems to be compromised by the fact that our copper mines are not pumping out any output. This is pretty dangerous, and therefore we're looking to see whether that capital that flows in is actually coming into some of these copper mines and reflecting into some of the growth that we're expecting. So that's another part that we'll take a look at. But if you look at copper output, this is the lowest level of copper output since July 2021. Okay, 66,900 is the lowest. So that's not a good signal for your copper stocks to start seeing copper start hobbling around this area. So we will be looking very closely in the first quarter to see if we're going to see copper still hobbling around this area or whether it's finally going to pick back up momentum. But for now, especially now that prices are strongly above 9,300, and they've been maintaining around 9,300, maybe we'll start to see copper prices doing much better. And as a result, you're seeing that there has been slow growth in terms of copper output. So possibly our mines might respond to much higher prices by actually pushing out more. But for now, there has been slowness in the copper output sector. Now, let's take a final look at non-traditional export. Non-traditional export, by the way, slow copper growth also means governments is under pressure to borrow because taxes that they're going to be earning from copper is lower. Now, the prices might help them out, but if we're getting $513 million in copper sales, or what's it, copper export, then even mineral royalties are going to come in weaker, and therefore the government will feel the need to tap into the markets a little bit stronger. So they may not reject. So in the interim, there might be some upward pressure on a little bit of interest rates. You may not find it, but the ability to decline interest rates may not be as strong from our government because the revenue that they're obtaining from copper is not as strong. And even their ability to offset the currency also becomes compromised because 75% of Zambia's supply of US dollars comes from copper sales. So if we are failing to bring in dollars because copper sales are anemic and they're starting to drop, therefore even the central bank's capabilities to push in dollars to offset the currencies starts to get weaker and weaker. So pay attention to that. Your dollar is now an asset that's playing a little bit stronger. So make sure you got a little bit of it in your portfolio. If you've got it part of gold, gold will also do that. The other thing about gold is it represents both the dollar. So we're seeing slowdowns in industry for the meantime, which is our copper sales are slowing down a little bit. So your defensive assets, once again, are speaking to this. Your aggressive assets are not. Now, let's take a look finally at the agricultural sector. And this is where I'm going to end today, looking at the prospects of agriculture. We did see a dip back to $82.6 million, but this is much higher than what we're seeing in the previous years. $82.6 million worth of agricultural export just in the month of December alone. You can see that last month, November, the previous month, November, was a record, the first ever month on record that we saw $100 million of agricultural export. This country is on track to see $2 billion worth of agricultural export a year by the year 2026. So while copper seems to be slow out the gate, agriculture is running hot. But remember, this is causing inflation too. Agricultural exports of this level is causing inflation because think about it, $82 million worth of agricultural exports, $100 million. And mind you, by the way, if you look very carefully, this has all happened also while the exchange rate has gotten weaker. That means large volumes of agricultural produce is actually leaving Zambia. Okay, and therefore it's creating a lot of scarcity on the market, causing a large problem with prices. Remember, the more scarce things are, the harder things are to find, the more expensive they are. I want you to put that in your mind. Say it again. Someone can write that for me in the comment section. The harder things are to find, the more expensive they become. Okay, so I want you to try and pay attention when it comes to this. So that's what this momentary price shock is also showing. But agricultural goods, agricultural export in that area is actually quite strong. So we're seeing that, yes, agriculture was doing very strong, but currently it's still about 20%. 20% growth in agriculture is actually quite good, 23%. Now, I want you to just take a look at this final graph here, especially for those agricultural stocks. And this is the performance of agricultural export over the last 4 years. And if you take a look at it very carefully, what you'll find is that agricultural exports have gone from $527 million back in 2019 when we had a lot of export bans to $750 million in 2020, which was a record year already. And bang, we boomed through that record with $918.78 million, which is the record highest, and it's putting us on track. So you can see the growth momentum picking up in agricultural export, especially with this Russia-Ukraine war, which has made food export all that more necessary. So you're actually starting to see that performance. So this is some of the data I wanted to share with you, to everyone. Make your decisions based on this. So growth there are some pockets of growth that are looking strong, but you have to be careful. It's not a broad-based economic growth. It is possibly the agricultural sector, non-copper sector, but your copper stocks, those will take a bit of a beating just for the meantime until we start to see the reflection of that. Now, that doesn't mean the growth story is gone. One of the interesting things, like I said, is capital goods importing. The fact that we're importing so many capital goods means that we're seeing people prepping to ramp up production in certain areas, be it copper, be it manufacturing, be it agriculture. It appears we're getting a lot of equipment in this country for production purposes. So those capital goods are really good. They're a signal of future growth. So don't shy away too much from the stock market. Just prepare yourself and be cautious. Build up into your bond market and pile in while interest rates are high, with preparation to have a little bit more in the stock market, especially when growth picks up, inflation comes back down. Because once that extra capacity on the economy goes online, so when you're buying factory equipment, it's to increase capacity of factories and therefore increase output. So once that extra capacity comes online for the purpose of pushing out more product, we should start seeing prices start to level off as well in the food sector if we can start to produce more for all these trade deals. So there's a lot of mechanization importing that's happening right now that should actually drive quite a bit of this. And also simultaneously, you are just trying to make sure you ramp up for the meantime, because remember that the debt deal, once that debt deal gets sorted out, you will start to see interest rates probably coming down. And the signals you'll start to see this is, one, there is talks now of, there is more the market is starting to price in 0.25 US Federal Reserve interest rates. So in other words, much lower interest rates coming from the Federal Reserve. So that's pushing interest rates down. South Africa, instead of doing a 0.5% rate hike, did a 0.2% rate hike, meaning they came in lower. Canada is doing lower rates, and they're also saying they're going to hold off on rate hikes. New Zealand just all out stopped, and you're starting to see much more countries cooling off. So the perception of rate hikes is getting weaker and weaker. So the interest rate war seems to be losing steam, meaning that they're going to be a neutral point where, and if a recession hits, interest rates will come pushing back downwards, and a lot more of that global capital comes squeezing back into the developing world countries like Africa. Now, in developing countries like Zambia, in the continents of Africa. Now, in countries like Zambia, if we sort out our debt, that makes us more attractive. Because remember, the biggest barrier to people bringing capital into our bond markets is our debt default status. So once that debt default status wipes away, banks participate more global capital comes back in, interest rates and bonds come down. Now, if you have a situation where those interest rates come down faster than inflation because of offshore participation, that means that your bonds will have a temporary moment where they're not going to be performing well. So this is why I keep saying pile in now while the premium on bonds is really high above the general inflation threshold. It's the premium on bonds is there, and hold your defensive assets, hold the line. If you're going into the stock market, get your defensive stocks, your cash flow generating, and look for stocks that have got something called pricing power. Companies that in the middle of inflation and in low growth are essentials. Meat production, those are very good essentials. Sugar, those are essentials. So you're looking for the kind of stocks that represent the essentials on a person's budget, that even under high inflation, they're still going to buy them regardless of the price. Look for companies with pricing power, and look for companies that are essentials that have to stay on the market. That will give you what to be buying on the market. And then to also look who out of the unit trust managers is taking a more aggressive stance on growth and who takes a more defensive posture. The defensive ones are probably going to hold on to blue chip stocks and the stocks that will perform even in an inflationary semi-slowdown environment. So that's the advice I can give you for this moment of how to navigate thanks to the trade data and the inflation data. And I'm going to try to do this every time data reads come out. Now I'm going to read some of the questions that some of you have put out to see what we've got here. Okay, Chilufia, you've written here. So Chilufia, thank you. I'll give out your example. You said, I like the speed gun example, makes it easier to understand. Thank you very much, people. Inflation can be easier to understand. Let's try and, but if you still do have problems, I understand. We can always work this out. Chilufia, you've also written, will the economy doing better reduce the price of stock or raise it? Or could it be okay to still have a bit of stock as to take advantage of the current stagnant prices? So I don't know if you're talking about, if it just clarify, you're talking about stock because you're talking about stocks in the stock market, because yes, the current stagnant prices in the stock market, yes, it can be a good time to buy up some of them, but you need to be strategic as to the industrials. The industrials are probably going to be what your best ones are. Now, we're just trying to figure out when copper output is going to pick up, because copper prices are doing well and the expectations at copper output. Yes, thank you very much for clarifying the stock market. Would it be a good time to start buying the stock market when it is low? It always a good time to buy when people are selling, but you need to be strategic about what you're buying. So that's why I said pick up what you can for the things that are probably going to come out. Industrials, yes. Copper stocks are taking a little bit of a hit, but you can take in your positions. Why I'm telling you to pile into your bond portfolio now is because those interest rates may not last long. So what you want to do is pack in as much of them so that when the dip happens on your interest rates, when the lower inflation in the lower inflation triggers lower interest rates in the global environment, and we sort out our debt, when these two things cross over and you start to see interest rates coming down, the safe part of your portfolio has got high interest rates, and then you slowly buy in. So just wait for the trigger. When the bond rally starts, go in very quickly. That's what you want to do. But lay in wait. Somewhere around the fact that when we start to see before the global environment lowers its interest rates and gets to a point where it starts lowering, and you see us sort out our debt, that's a signal to start buying some stocks. Okay, so that's your signal to start getting into the stock market a little bit stronger, but not too all day, just a little bit stronger. But pile into your bonds is to make sure that your fixed income part, the safe part of your portfolio, has gotten that maximum interest rate to ride the storm of lower interest rates and potentially lower and potentially interest rates that might dip below inflation, where real yields might get negative for just a brief moment until the inflation curve hits that 6 to 8%. Danny Zulu has said the harder things become to find, the more expensive they get. Thank you for remembering to write that down. I don't know if there are any more questions, people. I do these sessions so that you can all ask questions. But please go out there, look at your portfolios, plan yourself carefully. If you haven't gotten your education in investment, please sign up for Bonducation. It's actually very important. Bonducation is our course that we do. That is 500 kwacha. It gets you understanding of the asset markets and how to invest. I always talk about something called easy investing, which means get an education, get advice, get structure, and find your yes energy. Can someone please write that in the comments for me? Get an education, get advice, structure, and your yes energy. Okay, your yes is very important because it gives you that energy. So that's what you need to do. I will say it again: education, advice, structure, yes, energy. Bonducation wraps that up for you because I start by teaching you psychology of you and money, and then we talk about the history of money, and then we talk about government bonds. By the end of it, Bonducation, I always say that we need to get you to participate in an auction or to join a bond cooperative and participate in the actual investment. As low as 1,000 kwacha, and some of the bond cooperatives can go as low as 500 kwacha for a person to be able to participate in the government bond sector, and therefore to be able to pick up their first safe and easy asset that they're able to now start building as a portfolio, and then get confident enough to wrap themselves throughout the rest of the rest of it. And so that you can build your target towards financial freedom and secure your financial independence and mainly get to your financial freedom. So that's one of the things that we do with Bonducation. It's 500 kwacha for you to be able to get started, get your first education in investing, and then be able to then get advice. Remember that it also comes with the bond tracker and the bond calculator, which a lot of people are now being able to use to now start stockpiling, putting their data on their bonds into their assets. So that's something that you want to be able to start looking at, and also to find your yes energy so that you can continue doing it. That is what we are here to help you. Danny, you've got one more question to put here. The government introduced a deductibility of mineral royalty for corporate income tax in 2022 in order to boost production in the mining sector. Now that export volumes are for refined copper dropped from 903,000 metric tons to 893,000 metric tons. Did this move work? Well, it takes a bit of time, Danny, for that to reflect. I mean, we can't expect that tomorrow mining companies ramp up. They're going to bring in their equipment to ramp up output later on. So that is something that you have to pay attention to. They're bringing in equipment, but it's going to take time for that to reflect. It's like you as a person or as a small business. You can buy a piece of equipment, wait to get it, then load it, then see if you can increase your output. So there are various factors that play in. So we can't really expect it. But the problem has come from the fact that the historic prices of copper in this last year were pretty bad in the halfway of this year. And therefore, we're probably seeing the reflection of that in the output at the end of the year. So hopefully the bounce back will now lead to higher production. Because remember, they are driven by two things: price and profitability. Taxes will help increase their profitability, but price is determined by the market dynamics. Now, one of the key things, by the way, driving copper prices, which I'm very happy to see, is that we are still seeing 100% growth in electric vehicles. Electric vehicles are going to be the key driver because we've seen close to about 7.8 million electric vehicles come onto the road, and almost 10% of cars purchased in 2022 were electric vehicles. We're talking about cars that didn't exist a while ago, and now they're making up 10% of auto sales. So electric vehicle growth is on track to at least become a third, if not half, of all car sales by the end of this decade, meaning that we're going to see the growth of copper demand, especially after 2024, and also because China is coming back online and they're also removing a lot of their restrictions from COVID. So this will actually help push that on this. So I do think that we will see the market pull a lot more. The other thing, by the way, which might help them pull out a lot more copper from Zambia and do a lot more production, is the fact that First Quantum is fighting with the Panamanian government, who are demanding a lot of money from them. So you might see them shift a lot of their productive capacity to Zambia because Cobra Panama is having issues here. There's environmental restrictions that are coming on. There's issues of that $375 million payment that the Panamanian government are demanding. So a lot of this pressure that Panama is putting, which made Cobra Panama the #1 producer for First Quantum, might play into Zambia's hands, where FQM now starts to open up a lot more production there. So there are two factors driving it. Issues in Panama, South America, Chile is having issues, strikes in Peru. South American governmental issues plus electric car demand. These two things are probably going to squeeze a lot more output from Zambia. So copper stocks are still not too bad. Look at those trends they'll play. It's just in the interim where there's a little hiccup. So even first half data may not be so great for copper stocks. But I'm telling you, the second half, the way things are looking in South America, where there's all that instability and the way EV demand is going, there seems to be a squeeze on copper demand that's coming up. Okay, someone has written, any progress on use of mobile money to buy bonds? That's you're asking for government change. Those are things that take like 2 years to happen. So I don't think so anymore. Maybe not yet. Give it a bit of time. Give it a bit of time. If it happens faster, I'll be shocked. But you're asking the wheels of government to innovate on something that's a bit sensitive. We haven't even worked out buying. I know that we're starting to trade stocks a bit, but even that's a bit dodgy. The problem with mobile money is they haven't figured out the KYC issues for money laundering purposes. So they just want to be very careful, because when you're dealing with securities, you don't want to have money flying in through mobile money accounts going into money laundering. So there's always going to be a lot of regulations, risk, and all that stuff that takes place. But eventually we'll get there. Now, the secret to investing using mobile money is to join a bond cooperative, because those guys collect money. Okay, the secret is to join bond cooperatives, because then the bond cooperative creates a central bank account. Now, you got to make sure you vet these things, and we are trying to make sure these things start to become more official, because bond cooperatives, I don't want them to become agents. Now, we only overlook these. We only look at these things under bond education graduates. So we've got 5 bond cooperatives so far. Those ones now pool money in different ways, and then they do their transaction as a cooperative. That's a different story. So that's the kind of private sector workaround that has occurred. Okay, that's your most effective way, actually, to hold virtually hold bonds through a bond cooperative. Does give you access to do it through mobile money accounts. There's a guy named Mr. Patrick Marley who you need to speak to for that. But that is not, remember, you have to be very careful. Okay, always make sure you vet. I am telling you now to be very careful, and always make sure you take your steps. Now, when it comes to these bond cooperatives, I'll tell you one thing. I'm working on making sure they've got risk policies, they've got anti-money laundering policies. I am actually working in this first quarter to make sure that we clean up those things, to make sure that they're low on risk, and to also try and make sure that they're formal now. That is the main thing that we are trying to do. We're trying to do a lot more formalization so that they are respectable and they're operating properly. That's why we don't want these things to become engines of rampant corruption and problems. We want to make sure that they're operating very well. So there are some things that we need to fix in there going forward. As a risk manager, these are things I have to see, and I have to make sure that they're done properly. So risk management is something that has to be done very well to protect the members and to make sure that all is done well. But that is the workaround for now, before these things scale too fast. All right. Thank you very much to everybody for joining me. I know that we've knocked this out for an hour. I've given you your data. You've got your responses. I'm expecting more investment activity happening, and I'll meet you again here next month. Thank you for being with me. Have a wonderful day, and God bless to you all.